Charlie Munger, billionaire investor and Warren Buffett's right-hand man, has said that investing your first $100,000 is the most difficult part of creating wealth. At an old Berkshire Hathaway Shareholder Meeting in the 1990s, a young man asked Charlie Munger for his best advice on investing and building wealth. The young man complained that he was having a difficult time getting started, and that his net worth wasn't increasing at the speed that he had hoped. This is when Charlie Munger expressed a quote that has become a famous soundbite within the finance industry. He said, "The first $100,000 is a bit, but you've got to do it. I don't care what you have to do. If it means walking everywhere and not eating anything that wasn't purchased with a coupon, find a way to get your hands on $100,000. After that, you can ease off the gas a little bit." Of course, Munger isn't alone in saying this. A lot of people have shared this insight over the years. But what is actually meant by this? And why is the first 100k such an important milestone? To find out, I wanted to study the maths and the theory behind this claim. And the results that I found were really surprising to me, and something that I've not seen anyone else talk about before. To explain this and share my results, let's talk through a theoretical example. Imagine that we have an investor who invests $10,000 every year. And let's also assume that their investment grows by 4% each year. This is a prudent assumption, as I see a lot of people assume a 10% growth rate, but I don't feel that that's sustainable and achievable over the long term. And as a qualified accountant, being prudent and undershooting is more realistic, and something that I'm more comfortable with. So looking at this graph, after 8.58 years, so around 8 years and 7 months, our investor will have amassed $100,000. And if our investor continues to invest $10,000 each year, and the 4% growth rate stays the same, they'll be able to achieve their next $100,000 in only 6.41 years, a much shorter time frame. And if we look at this graph, up to a portfolio of $1 million, we can see this process in action again, as each $100,000 that's generated is done so in a progressively quicker time period. Let's take a moment to reflect on this. Our investor is still contributing the exact same amount each year, but the money they already have in their portfolio is working for them behind the scenes, churning out more and more capital at a faster rate each year. In fact, it took our investor 8.58 years to reach their first $100,000, yet it only took them 7 years to go from $700,000 to $1 million. And that is the power of compounded returns over the long term. A really interesting point worth noting is that hitting the $300,000 mark is actually halfway to $1 million. And that might sound absurd, but using our example, to go from $0 to $300,000 would take 20.11 years. And then to go from $300,000 to $1 million would take 20.94 years. Quite amazing when you think about it, and again demonstrates the magic of compound interest. So why does this happen? I wanted to understand some of the reasons behind why hitting that 100k milestone was perceived to be so important, and have come up with 3 main reasons: exponential growth, portfolio size, and intangible benefits. I'll explore each of these points in more detail to hopefully help you appreciate this concept further and help you to become a better investor. I believe that one of the main reasons behind why achieving the first 100k is so beneficial is down to exponential growth. Using another theoretical example to explain this concept, let's say that you invest $6,000 a year for 40 years at a 6% growth rate. At the end of the 40 years, you'd have $9,968,658. So common thinking would reason that if you invest double that amount, so $12,000 a year, you could achieve the same gains in half the time, i.e. 20 years instead of 40. Sadly, this is wrong. $12,000 a year over 20 years at 6% is only $449,472. And it's this reason why the first 100k is so important, as it allows for greater exponential growth into the latter stages. So the sooner that you can hit this point in the present, the more that you can benefit from it in the future. Let's look at this idea in a visual format to better understand exponential growth. Linear growth would look like this, a straight line. Linear growth occurs by adding the same amount over each unit of time, whereas with exponential growth, an initial amount increases by the same percentage over each unit of time. You can see from the graph how the line starts off at a really slow pace, but then the gradient gets steeper and steeper as the time passes, before really ramping up towards the end, which are where the high gains happen. This is because you're earning interest on interest, and so the larger that the capital amount grows, the larger the interest that gets applied. The second point to note is that the larger your portfolio becomes, the larger the gains and losses become as well. At a 5% return, a $1,000 portfolio would increase by $50 in 1 year, but at a 5% return, a $100,000 portfolio would increase by $5,000 in 1 year. That's $5,000 for doing absolutely nothing. It's the same percentage, but a huge difference in the outcome. And the following year, that $5,000 increase would be $5,250 due to the effects of compound interest. Remarkably, at the end of 5 years, that 100k has now turned into $127,628, which sounds too good to be true, but the numbers don't lie. The third point to note on hitting 100k is the intangible benefit for the investor. We've talked about the tangible benefits of hitting 100k, i.e. things that you can physically see, but there are other intangible benefits as well that won't be so visible. To get to the 100k point, you will have had to go through the process of establishing a number of good financial habits. But once you've built these foundations, all you have to do then is maintain them. People don't like change and prefer to stay in their comfort zone, so you have to fight against your natural urges and instead embrace change. If you don't, then you'll be stuck with what you've always had. For example, to get to the 100k mark, it's likely that you will have had to develop the following 6 habits and behaviours. The first one is budgeting. A budget helps to create financial stability for both the day-to-day and the long term. By tracking income and expenses and following a plan, a budget makes it easier to know how much you are likely to spend each month, and therefore how much you'll have left to invest. Additionally, budgeting can help you to really stay focused on your long-term financial goals, and gives you a strategy that you just have to stick to achieve those goals. For example, if you invest 20% of your income for X amount of years, you will have a portfolio that is X in value. The second habit is that you will have had to make regular contributions and be consistent and disciplined. In order to build up a sizable portfolio and hit the 100k target, you will have to make a lot of contributions. If we assume 5% growth at $500 a month, 100k would take around 12 years, and you'd be depositing 144 lots of $500. At $1,000 a month, this would take around 7 years, and you'd be depositing 84 lots of $1,000. Those are a lot of contributions, so it's important to stay consistent and disciplined to form this habit, and watch your portfolio rise each month. The good thing about habits is once they're built, they can be hard to break, and a lot of brokers do offer automatic deposits, which will help to automate the whole process each month. I use Trading 212, which can facilitate automatic deposits, and if you do want to sign up with them, use my link below and you'll get a free share worth up to £100. Thirdly, you will have developed your financial education. You'll likely start fawning over stocks in the same way that a lot of people fawn over TV shows and sports teams. Researching stocks and spending money on investing will replace researching and spending money on consumer goods. Books on personal finance and investing will replace entertainment magazines. And investing YouTube channels will replace reality TV shows. Starting your investing journey is exciting, and you'll be learning about a lot of new finance concepts that won't have ever interested you before. And you won't ever reach an endpoint, and you'll always be learning new ideas and new theories that will help you on your investing journey. The fourth point will see you ride out market fluctuations. If you are holding a stock portfolio for any length of time, chances are that you'll encounter some heavy market fluctuations that could wipe thousands off the value of your portfolio in unrealized losses. Learning how to stay patient and unmoved through these periods is a really important skill to develop. Too many people see the value of a stock declining, and then they panic sell thinking that it's going to go to zero. However, if you were happy buying that stock originally, and the fundamentals of the company haven't changed, then you'll soon realise that this is just short-term noise. And the stock market does this a lot. Here's an inflation-adjusted graph from 1950 of the S&P 500. Look at how many times that the price has dropped, yet the overall trend of the chart is positive. When you first start to invest, psychologically you will likely pay a lot of attention to every single fluctuation. But eventually you'll learn to understand that sometimes the market bounces up and down for irrational reasons that you just can't explain. Over time, you'll learn to ignore market corrections, or even view them as buying opportunities to average down or scoop up bargain prices. The fifth intangible benefit would be that you'll look to reduce your expenditure and scrutinise what you spend your money on. The need to save money to invest is going to result in some difficult questions about your lifestyle, what you're buying, and how you're prioritising your spending. You might start seeing if you can get a cheaper phone contract, cook all your own meals at home, rent a cheaper apartment, or drive a more economic vehicle. These small changes to your lifestyle can make a huge impact on how quickly you can save your first 100k. Don't underestimate the financial impact of tiny recurring expenses, as the little spends all add up. And the final benefit of trying to hit the 100k mark is that you'll look to increase your income. Compounding just doesn't have the same effect when you're working with a smaller sum of capital. Therefore, if you have cut back your expenses as much as possible, it's likely that you'll now need to look at increasing your income. After all, at some point, you will hit a floor with your expenses, where you just won't be able to go any lower. However, with your income, your earning potential is unlimited. This will enable you to invest more and therefore build up your portfolio more quickly. And you could look to achieve an income boost through salary raises, a second job, or a side business. Once you do reach the magical 100k mark, gradually over a period of time, it'll mean that you've built up strong habits in all of these 6 areas. You'll have a budget that you stick to, invest consistently every month, have acquired a vast range of investing and finance knowledge, learnt to deal with market fluctuations, reduced your expenditure, and increased your income. So once you hit that 100k figure, it's likely that you won't stop there, and you'll be looking towards the next 100k, while your first 100k is going to keep on growing. Hitting the first 100k is hard, because it requires you to actually start investing. The hardest step is always the first step. It doesn't matter what you're doing in life, starting is the most difficult but also the most important thing to do. 100k might look like a mountain from the ground, but to scale that mountain, you really do have to take that first step, then the second, then the third, and so on and so forth. Once you actually start building and rolling that snowball, things naturally begin to move along at a nice pace. And once you achieve the target of the first 100k, continue to invest wisely and your money will compound over the years. Something that I'd like to remind everyone is not to be discouraged if it takes you longer than you'd hoped to save your first 100k. This is by far the hardest 100k to accumulate, and will likely take you the longest to save. I'm still pursuing it myself. But once you do cross that point, it seems that the path only gets easier from there on in. So how far are you away from hitting the 100k mark? Has anything in this video surprised you? Let me know in the comments section below. I'll be reading and responding to every message that I can. I hope that you found this video interesting and informative, and I hope that it's given you inspiration and ideas for your own personal finances. If you have enjoyed the video, please drop me a like and subscribe to the channel to make sure that you don't miss any future videos. Thanks again for watching, and I'll see you in the next video.